mind since the Q4 deadline is coming up. Estimated taxes. So first of all, we're going to start off talking about the challenges you face estimating taxes. How do you estimate taxes to begin with? And then how can S Corps make estimated taxes less of a burden for you? And why, again, beginning of the new year, you should start now. So, and then we'll also talk about how collective makes taxes a no-brainer for you. And then we'll open up to your questions. So at any time during this presentation, if you have questions, please type them in the Q&A. We want to hear from you. I want to make sure you're getting your questions answered and you're getting the most out of this as you can. So please ask questions and we will get to them at the end. But who are we? So we are Collective, and we are the first all-in-one back office platform designed for self-employed people. So those freelancers, those businesses of one, we are here to support you. And I'll get into basically what services we provide later on, but we're excited to have you here and hopefully we can talk to you soon. So, challenges you're facing with estimated taxes when you're self-employed. So, this is you're just happily running your business. You're doing what you do best. You're signing those contracts. You're getting those new clients in. Life is good. But there are all these other issues floating around out there that you just don't think about. So, estimating taxes is a big one. And I'm going to harp on this whole presentation because I see people get hit so hard with it. They think they're doing what they're supposed to do. They're making money all year. Life is good. And they get hit with a huge tax bill when they come to pay their annual taxes, and there are penalties. And it's just a mess because you didn't expect it. You didn't save for it. So let's not have that happen. I'm going to keep harping on it because I just see it so much, but you can do this. We can help and we can get through it together. But anyway, back to this. You're just happily running your business and all these issues are, floating around. Again, having enough money to pay taxes, your federal estimated taxes. Don't forget there's state estimated taxes, interest, ongoing compliance. So what forms do you have to file? Penalties, guessing how much you owe. So once you realize there's so much to do, this becomes your face. How do you estimate taxes? Are you putting enough money away? Will you face penalties? So again, we'll talk about this a bit later, how Collective can help, but we can help turn that frown upside down. Yes, I'm not cheesy. But this is a lot of information that we're going to be talking about today. Yes.
It looks like your slides are still on the Collective red screen and not moving through.
Do you see anything moving now?
No.
Oh, okay. Stop sharing for a moment and reshare. I apologize, everyone, for the technical delay, but we'll be right back. There we go.
Andy, we see them. Yep.
Yay, success. Yay. Thank you, Andy, for the guest appearance too. All right. So, well, if you missed out, there was a smiley face. I probably sounded crazy because you didn't know what I was talking about. Now there's a sad face because you've realized everything you need to do. And as I said, we'll talk about how Collective can help, but really you can get these issues, you can get all these things under control. You just have to face them, and it's the beginning of the new year and that's time to do it. So what stresses you out the most when it comes to estimated taxes? We have a poll. So let us know. So is it calculating your estimates? Like, how do you do that? Is it actually paying it? Is it you're afraid you're going to be hit with this big tax bill at the end of the year with penalties and you didn't pay any of your estimates and you're just really stressed out? You feel like you're paying too much in taxes because of self-employment tax, maybe? I mean, definitely part of it. You don't know estimated taxes exist, so you didn't know to pay them and now you're panicking. Maybe you forgot to pay estimated taxes. You knew they were there, but you just never got to it, which is very fair. And then maybe you just don't know who to go to, who you can trust to calculate your estimated taxes. So let us know. I know these, so all of these issues are, I mean, very fair. People who are used to having a W-2 job just don't even think about estimated taxes. I know I wouldn't think to pay them. So this really is an area that a lot of people struggle with, get hit with. And so let's make sure that never happens again. Yeah, just there you go. Thank you for your answers. All right, now that we've identified what stresses you out, let's actually talk about estimated taxes. So who should pay them? This is a big one. So if you think you could owe $1,000 or more in taxes that year, which is usually independent contractors, people who own their own business, people who file as sole proprietors, or people who either own entirely or own a share of an LLC, usually you could owe $1,000 in taxes. It's a very low threshold. And when I talk to people and when I think about it, if you have income where there is no withholding on it, so you're getting paid a 1099, you should be paying estimated taxes, unfortunately. This is just, there's no escape. And remember, this is both for federal and state. States have estimated taxes too. We're going to be concentrating on federal estimates right now. I'll mention one state a little later, but remember, this is both. So don't forget your state as well. And all of them have different rules, of course, right? They can't make it easy on us. So we'll go into that a little bit more, but just know this presentation is primarily focusing on federal estimated taxes. All right. Why do you even have to pay estimated taxes? Isn't it enough that you pay this bill at the end of the year? What more does the IRS want from you? Well, the IRS wants a pay-as-you-go system. So they want you to basically mimic having a normal W-2 job with withholding. So estimated taxes are a way for the IRS to get you to pay as you go when you don't have that W-2 withholding. So really, if you are getting money without withholding, then you need to have estimated taxes on your radar. All right. Hopefully that makes sense. And again, if anything I say here today doesn't make sense or you have a question, please put that in the Q&A. We really want to hear from you and make sure this is a very productive webinar. So you get a lot out of it. All right. So let's just talk about estimated tax basics. So first of all, taxes must be paid as you receive or earn income during the year, whether that's withholding or tax payments. So as I said before, the IRS wants you to basically mimic a W-2 withholding system with your estimated taxes. So if you don't have a W-2 and your taxes aren't being withheld automatically, the burden is on you to calculate your estimated taxes, to save for them, and to pay them to both the IRS and state. So you got to be aware of it. You got to keep thinking about it, unfortunately. Because the threshold is so low, it's $1,000 or more, most sole proprietors need to be making them. So how do you even estimate your taxes? How do you know? How do you know how much you're going to be making? How do you know that estimate's correct? So these are things that, again, you got to be thinking about and continuing. Put that calendar reminder on your calendar. So if you don't pay enough with tax withholding and estimated taxes, you can be charged a penalty. So this is unfortunate, but there are rules where you can avoid penalties. So there is a federal safe harbor rule. So if you paid at least 90% of the tax of the current year or 100% tax of the shown on the prior year return, whichever is smaller, you can avoid penalty. Additionally, if your income is received unevenly during the year, you may be able to avoid or lower the penalty by annualizing your income and making unequal payments. But remember, there can be a penalty. So even if you're due a refund when you file your tax return, you can still get a penalty if you haven't paid your estimated taxes on time. So just keep that in mind. It is what it is, guys, but we can handle this. We're facing it. You're here. This is great. All right. And when do we pay them? Most importantly. So they are due April 15th is Q1, June 15th, Q2, September 15th, Q3, and January 15th of the next year is Q4. So January 15th or the next business day of 2022 will be your Q4 2021 payment. So it's coming up 10 days away, but you guys got this. You're here. Don't stress. There's time. So let's get down to business now that we've talked over the overview. How do you calculate your taxes? So as I mentioned before, there's this safe harbor tax rule. And this allows you to pay in estimated taxes. And if you pay in these amounts, then you're not going to be hit with a penalty, even if they were wrong. So if you pay 90% of the current year's taxes or 100% of last year's taxes, whichever is lesser, then you will not be hit with a penalty by the IRS. So woohoo, some safety. But how do you even calculate these? So with 90% of your current year tax, you estimate what you're going to owe. And I just use some easy numbers here. So say you owe you're estimating that you will owe $1,000 in taxes. So 90% of 1,000 is 900. And then for the IRS, they want you to pay more equal payments generally. So divided by 4, 225 is what you would pay each quarter. Then you have to run the second analysis. So 100% of last year's taxes. And this is, you're going to be looking at your tax return for this. So how much did you pay last year? What did you file on your 1040? That's what the number for 100% of last year's taxes. So let's just say hypothetically, you owed $2,000 in taxes last year. So 2,000 divided by 4 equals 500. And so that would be your quarterly tax estimate based on last year's taxes. Then you look at which one is less. So 225 is your payment. Again, let me know if you have any questions, but this is just a very, very high level overview. So following the safe harbor rules, again, will make sure you don't incur any penalties, but you can also run an analysis to base it on your actual income. But how do you do that? So estimating taxes based on actual income and deductions. So pretty much you have to run through a full analysis. So you start by estimating your adjusted gross income. And this is all of your income coming in minus certain adjustments, such as business expenses. Then you calculate the tax. So you take taxes into account. You multiply your estimated AGI by your applicable tax rate. And then your AGI times your taxes equals your estimated tax payment for the year. Then you divide that estimated tax payment by 4 to determine the amount you should be paying each quarter to the IRS. So this can be in depth, but you can do it. There are multiple ways. You can either do this by actual income or by the safe harbor rules. So there are options. Estimated taxes are not just for the federal government. Remember, states have them too. And states have many different rules. They don't make it easy on you. So please check with your local taxing agency to see if you do need to pay state estimated taxes and how much you should be paying. I live in California, so this is what I'm most familiar with. So California, generally, if you need to make estimated tax payments, if you expect to owe at least $500, which is again, very, very low, or $250 if you're married. So pretty much, again, go back to thinking, do I have income without withholding? Yes, pay estimated taxes just to be safe. And California also goes along with the federal safe harbor rule. So you can pay 90% of the current year's tax or 100% of the prior year tax, whichever is smaller. So California kindly gives us a break on that. And we have those safe harbor rules in place. Again, not every state adopts that, so be sure to check. Instead of equal payments, California is different. So you pay 30% of estimated tax on April 15th, 40% of estimated tax on June 15th, 0% of estimated tax on September 15th, and 30% of estimated tax on January 15th of the following year. So again, that January 15th date is coming up for Q4 of 2021, which can help you reduce the amount you're going to have to pay in April. So think about it, be aware, but you can face this. You can do this. It's not that scary. We're here with you. All right. So what happens if you don't pay estimated taxes? As I mentioned before, you can be subject to an underpayment penalty and interest when you go to pay your annual tax bill. So this can get painful. This means you could have a big tax bill waiting for you at the end of the year that you did not expect and did not save for. So even if you're going to do a refund when you file your tax return, you can still be hit with an underpayment penalty for missing an estimated tax payment because you didn't pay as you earned income. The IRS really, really wants you to be paying throughout the year, just as if you had a W-2 with withholding on it. So this is, again, a pitfall. It can hit you and you can't, and it'll be a surprise. And we don't like surprises in taxes. We want to know what's going on. So just be aware. So what taxes are estimated tax payments based on? Because I just went and I talked about how you calculate it and your tax rate. What taxes are we even talking about? So estimated taxes are based on income tax and self-employment tax. So this does not cover any of the indirect taxes. So I'll give you a reprieve on that today. But these are the two taxes you need to be worrying about it when estimated taxes. I like to say the IRS is the ultimate mob and they want their cut no matter what. So make sure they get their cut. Income tax, what is it? So it's what you're generally thinking of. So what people generally say when they say taxes, they mean income tax. Individuals pay between 0% and 37% based on your tax bracket or your income amount. So this is what you generally are hearing when you hear taxes. Then what is self-employment tax? So this is a flat rate of 15.3%. So an extra amount on top of your income tax. And this goes to Social Security and Medicare. It is basically making up that withholding. So on a W-2, you get income taxes withheld and you get the Medicare and the Social Security taxes withheld. The self-employment tax is to basically make that withholding up. So you get your income tax and then the Social Security and Medicare taxes, just as if you were a W-2, but you have to pay them out separately since you're not getting any withholding. You don't have a W-2. So as an employee, like I said, normally when you're getting that W-2, half is paid by the employee, so 7.65%. And then half is paid by the employer. Because you're self-employed and you're getting income with no withholding on it whatsoever, you're paying both halves. Now, I am a visual learner, so hopefully this is helpful to you guys too, but it's much easier for me to see it. So as an employee, you get 50% paid by you and 50% by the employer. As a self-employed person, you get that whole thing. It's all on you. So that's really why it's so expensive, because there's no employer. You're both. You're the employee and the employer here. Again, this really helps me just having visuals. So I hope this is helpful for you guys as well. So basically, this is your tax structure. So you're getting revenue minus your tax deductions equals your net income. And then this profit or loss is passed on to your owner. So as a sole proprietor, you're reporting that on your Schedule C. And then you have your business profits, which are subject to self-employment tax and income tax. So you're getting hit twice there. So it's that 15.3% plus whatever your income tax rate is. It's both on 100% of your business profit. I know. You're like, ugh, I hate this. But it is what it is, right? Why does this, but maybe Collective could help you. And if you find yourself in this situation and it seems really overwhelming, please give us a call. We would love to talk to you, talk through it, and at least if we can't work with you, give you a good idea of what's going on. So if this seems all too familiar, please schedule a call with us. Our business advisors would love to talk to you. All right, so why does all of this matter? Because S Corps can help you mitigate your tax burden, which reduces the amount of estimated taxes that you need to pay. Less taxes, less estimated taxes. We love this. All right, what is an S Corp even? So we say it's gonna help you mitigate your taxes and you pay less estimated taxes and less taxes overall. But what is it? How does this work? So let's take a step back. So we're going to get into all of these confusing abbreviations. So you hear people throw off LLC, SMLLC, LP, GP, LLP, Inc. What does this mean? So these are legal entities and they are distinct and separate from the owner, and they are formed at a state level with the Secretary of State. So each state. Entities are generally required to file annual reports and let the state know who manages them. This is separate from your tax return. The formation and information returns are done with the Secretary of State. So again, this is completely separate, but these legal entities are at the state level. And the ones I run into the most are LLCs, so limited liability companies, and C corporations. So what is an LLC? So a limited liability company offers you liability protection as the owner. So your personal assets are not available to satisfy business debts, but there's a flow through structure. So you're not paying tax at the LLC level. You're only paying at your level. So all of the income and deductions from the LLC flows through to the owner and is reported on the owner's tax return. And that's where you're paying income tax. C corporations, that's different. So legally, C corporations are seen as people. So just like you and I have to pay income tax, so does a corporation. So corporations pay tax at the entity level. And then also any money that is distributed out to owners is also taxed. So you've probably heard C Corps double taxation. And this is what people are talking about. There's that tax at two levels, the entity and the owner. Then you also hear things thrown out. What is a single member LLC? So SMLLC. So this is an LLC, but with one owner. And it is seen as a disregarded entity for federal tax purposes. So that means you're not filing a separate tax form with the IRS for a single member LLC. You're reporting everything on your Schedule C, just like you would as a sole proprietor, but you enjoy the liability protection of an LLC. But weren't we talking about S Corps, right? So how does this even related? Well, S Corps are weird. They have to be something else first. So you have to form an entity at the state level first, whether that is an LLC or a C corporation. Then you elect to be treated as an S corporation with the IRS. So S Corps are really tax elections rather than freestanding legal entities. So this is just a fancy way of saying the IRS will decide how your business structure is taxed. And when you file a Form 2553 and elect S Corp status, you get to be an S Corp. So I know, easy, right? So why are S Corps so great? You know, this seems like a lot of work. You form an entity at the state level, and then you have to elect with the IRS. Why would you do this? So S Corp owners don't pay self-employment tax on their profit. By having an S corporation, it creates a way for you to mitigate that self-employment tax burden, that extra 15.3% on all of your income. So how you do that is the S Corp creates an employer-employee relationship between you of your entity. You start taking a W-2. So your S Corp, instead of paying you directly, your customers are now paying your S Corporation. And S Corp has you as an employee, and you start getting a W-2. You are required to pay yourself reasonable compensation for your work. And we'll go into that a little more and what that means. But you get on payroll, you get a W-2, you're getting your federal and state income tax withholdings, as well as those payroll related taxes, the Medicare and Social Security. So it's that 15.3%, just like the self-employment tax, it's offsetting it. Then half of the payroll taxes are withheld from your paycheck and half are an expense to the S Corp, so even better. Then any profit left in your business at the end of the year, you're entitled to take as an ownership distribution. And this distribution is not subject to self-employment tax, only your income tax. So instead of 100% of the profit, you're getting that 15.3% applied to just a portion of it. And again, we have pictures because I'm a visual learner, and I hope this helps some of you guys too. So we have your S Corp revenue with expenses and your salary. Your salary is an expense, by the way. So you get your 15.3% of the payroll taxes, which is equivalent to the self-employment tax, only on the salary. Then the profit or loss flows through down to the owner's tax return. Since you've already taken care of that self-employment tax on the salary portion, the rest of the profit as a distribution is only subject to your income tax. So again, here's another picture. This one is probably my favorite, and I can credit Andy. It's brilliant and so simple, but it shows the difference between paying yourself a salary as an S corporation and then operating as a sole proprietor or a single member LLC. So profit is the same, right? So 150,000, this is pre-owner wages. With the sole proprietor or the single member LLC, you're not paying yourself any wages, so zero. Then 150,000 is subject to self-employment tax or the payroll, the Medicare, the Social Security. So the rate of 15.3%. So your total tax is $23,000, just self-employment tax. Then 150,000 passes through to profit as the owner, and then that 150,000 is also subject to your income tax, federal and state. So this is a lot. So you're getting hit with 150,000 for self-employment and 150,000 subject to income tax as well. Then you can look at the difference with the S Corp. So you profit pre-wages again is 150,000. The owner's wages, instead of paying zero, is 50. So what's subject to that self-employment tax or the payroll taxes? Only that 50,000. So that 50,000 is where you're getting withholding, so income tax withholding, as well as Social Security and Medicare. So for a total tax of 7,650, way better than 23,000, like about a $15,000 difference. Then you have the rest of the profit. So you have 100,000 in profit, pass through, not subject to self-employment tax. And then everything is subject to income tax. But you can see right there, that difference is powerful. $15,000 just by paying yourself a salary. I mean, that's a nice vacation. That is a very nice handbag. Or just savings, money for your business, liquidity, kids' tuition. So this really is a powerful tool in helping mitigate your tax burden. All right. Again, if you have any questions, this is very dense material. So please, please let me know. We want you to get as much out of this webinar as possible. So if you have questions, let us know. And we'd also love to talk to you. If this situation seems like it's your situation, schedule a call with us. Our business advisors are happy to go into the details of what's going on. Obviously, in this webinar, we can only talk about generalities. All right, so we like to say the S Corp is a small business owner's best friend. It recognizes that not all of your profit comes from the business is because of your work. Some of it is returned to building your business, so building your reputation. Like, you're the business owner, you've put in the work, you deserve that. It also recognizes that there isn't a large suite of corporate owners. You aren't a large corporation, and 2 layers of taxation isn't necessary. So we like to say, and I believe that S Corps really are truly a powerful tool in saving you taxes and also, your new best friend. So which one is best for you? So now that we've talked about, how great they are, which one is actually best for you in your situation? So LLC is best for people who are new to business and have very little earnings. So if you're earning less than 80,000 in profit a year, I would say even 60,000. If you're hitting 60,000 in profit a year, then it is time to start planning. And an S Corp could still be right for you. So I would say even 60 to 80,000 in profit a year, that's when you need to start thinking. Below that, maybe an LLC is better. And an LLC is also better for people who want a simple tax structure. So like I said before, a single member LLC is considered a disregarded entity for federal tax purposes. So there is no separate federal filing. It's just like being a sole proprietor, and you report that income and deductions on your Schedule C, but you still get that liability protection at the state level. So that can be quite helpful and let you sleep better at night, honestly. Who is an S Corp best for? So you're earning more than 80,000 in profit per year. Again, I would say 60 to 80,000. It's time to think about it. And maybe you want to maximize your retirement savings with an S Corp structure, because you now have an employer-employee relationship. It's possible to create an employer-employee matching program for a retirement fund. So this can be quite powerful. And as long as you have enough cash flow to make regular payroll runs, this could be really good for you. Again, you need to be making regular payroll runs because you're getting the withholding on your payroll. And that's the mechanism where we're saving on self-employment tax. All right, we talked about getting a salary, but how much do I pay myself? I alluded to this earlier, but it's not as simple as it seems, unfortunately. And this is an area that I truly believe if you are going to start paying yourself through this S Corp structure, whether it's collective or someone else, please seek out a tax advisor, at least at first. There is no set standard for reasonable compensation, and it is a facts and circumstances test, which, is variable. Generally, we see between 35%, 45% of business profit as a salary passes, but there's no sure thing in this. This is truly an area. Please seek out a tax advisor. Again, collective, this is included in our service, and we would talk to you on an ongoing basis about this. But it's complicated, and they've been fighting about it in tax court since the 1940s. Like, for example, the Fifth Circuit Court of Appeals has its own test. So they look at the employee's qualifications. the nature, extent, and scope of employee work, the size and complexities of the business, comparison of salaries paid with the company's gross and net income, prevailing general economic conditions, so how's the economy, comparison of salaries to distribution of stock of the stockholders, and the salary policy of the company to all employees. Also, the amount of compensation paid to employees in previous years. So there's a lot going into that, and no single factor is determinative. The Fifth Circuit considers and weighs the totality of the circumstances to reach a decision. So it is complicated and there's no magic formula. So please, please, please seek out some tax advice. Whether that's collective or not, I really do urge you to at least have someone talk to you about it initially. Other federal courts have similar multi-factor tests, but they vary. So again, this is a gray area where there is no specific standard. It's truly facts and circumstances. So please give us a call. If you're thinking about this, talk to us. We're more than happy to work through it with you. All right. So what about estimated taxes? We just talked a lot about S Corps. So what about estimated taxes? So S Corps can help make estimated taxes your friend. And, that's because, well, first of all, less taxes within S Corp means less estimated taxes. So we love less taxes overall. But with a sole proprietorship, you have zero withholding through a W-2. So you have to estimate the amount of income that you expect to earn during the year and then pay estimated taxes on the entire amount. So it's all on you. As an S Corp, you pay yourself as an employee and you do have some withholding through your W-2. You can even choose to increase that withholding to account for other income during the year. So that like withholding portion is nice. It can really decrease how much you have to pay on a quarterly basis. And if you don't increase, you only have to estimate on income earned above your salary. So again, less income to take account, you are getting some withholding through the year, and you can plan for other income. So again, we love S Corps, they're your friend. So what can you do now to make your 2022 estimated tax payments lower? Well, one, you can decide if an S Corp is right for you. So now is the time. It's the beginning of the year. You can get a whole year's worth of savings in right now. So now is the time to really think about what is right for you. What do you see coming in for the rest of the year? What contracts you have, what income you're projecting. So now's the time. If an S Corp is right for you, then it's time to register your LLC with the state. So form your entity and make your S election. If you already have a single member LLC, then you only need to go in, elect S Corp status. But it's the beginning of the year and it's time to think about it. And if these are things you're thinking about, please reach out to us. We would love to talk about it with you. Again, during this webinar, unfortunately, can only talk about generalities. So we would love to hear about your specific situation. Once your LLC is formed, then we would say, set up a business bank account, get your EIN, get your books in order, get ready to run payroll. It's time to save on taxes. And then it's time to choose a tax advisor that's right for you. So 2021 annual filings are right around the corner. So new year, new you, you're ready to start it off strong financially. All right. Again, why should you start now? So peace of mind, knowing that you're saving on taxes, knowing your budget, starting to run your first payroll. Because again, you don't have that mechanism of saving unless you're running payroll. So you can save for all of 2022. You can accurately pay your Q4 estimated taxes. You have time to concentrate on building your business once you get all of this settled. You can reduce your estimated payments for the rest of 2022 and being able to make your 2021 Q4 estimated tax payment since it's right around the corner. So these are all reasons to start now. Just I think the biggest one for me is that peace of mind and also the planning that you know for the rest of 2022, you know what you're doing, you're in your structure, you're saving taxes instead of waiting for the end of the year to panic. So start now for your peace of mind. So we have another poll. Are you guys thinking about switching to an S Corp now? Let us know what you're thinking. I'll give you like a minute. And again, please let me know if you have questions. We're going to do a Q&A at the end of this. This is a lot of information that I've been throwing out at you. So we would love to talk to you and hear your questions and make sure this is a productive webinar. So yeah, let us know what you think about switching to an S Corp. Give you a little more time. There we go. Well, thank you guys for participating. So now we're going to talk about collective. We are currently in California, Washington, Utah, Arizona, Texas, Florida, Georgia, Massachusetts, Virginia, and Pennsylvania. Say that 10 times fast. But we are currently serving those states. And so we would love to talk to you. What your S Corp finances without collective look like. So you have to do your setup. So filing paperwork with the state to form an LLC, and then electing your S Corp status with the IRS. You have to deal with, bookkeeping. So maybe you're using QuickBooks, maybe you're not, maybe you don't know. There's ongoing state compliance. There's just taxes. So your S Corp tax return, which is the 1120S, and your 1040 we have to file. Calculating reasonable compensation on your own. I just, as I said, it's, not a simple formula, unfortunately. What payroll software are you going to use? How are you going to run payroll? Do you need to register as an employer in your state? Estimated tax calculations. Worrying about retirement funds. How do you set that up? How do you make it work with your payroll? And just ongoing advice. So knowing that you have someone behind you to advise you and make sure things are under control. So your S Corp finances with collective though. See the smile? Because you're not alone anymore. And all of this is included in our service. So your S Corp setup, your QuickBooks Online and bookkeeping, payroll, ongoing financial advice, state compliance, S Corp and personal taxes, and your S Corp setup. We will do it all. So this is what to expect with collective. So we will handle your formation. So this means filing forms with the state to form your LLC, and then filing your S election. We'll also obtain your EIN, advise you on retirement plans and health insurance, and also reasonable compensation. So that conversation will be an ongoing one with us to make sure you're in a defensible position. So then we move over to bookkeeping. We do have full service bookkeeping now. This is a big deal. We're really excited to be able to offer you this. And I sure know wouldn't want to do my bookkeeping. So let us do it for you. So we will set up your QuickBooks, which is your bookkeeping tool for us, and your Gusto, which is your payroll platform. So we will help you with training. We'll run profit and loss statements. We will do reconciliations and classifications. All you have to do is log into our platform and look at that profit and loss statement. Bookkeeping is taken care of, so is payroll. So we will also estimate your tax. So we'll provide you with an estimated tax calculation and a reminder to pay them. And we will help you with any reasonable compensation adjustments, reminders to file important state paperwork, and you'll have a personal financial team you can message with questions. We also, on top of all that, prepare your annual tax return, so federal and state, as well as your estimated tax reminders. So this is big. You no longer, the burden for estimating your taxes is no longer on you. You don't have to remember them. You don't have to do it. We will handle that for you.